How you doing? I'm Earl Ware with United Real Estate down here in Columbia, South Carolina. We have Abi Snyder with Assurance Financial. So excited to have her today. We're going to do a little Q&A, and then I'm going to have her at the end do a little discussion on the products and services she offers, and we're just going to get right into it. How you doing, Abi?
Hey Earl, I'm doing great. It's a beautiful day.
Yes, it definitely is. Temperature's good. It's been cold and hot, but it seems like it's staying steady. So we'll see how it
Yeah.
goes.
No sweat yet, just a
No,
little pollen.
that's right. Okay, the first question I'm going to ask is, you guys are an actual lending institution, it's
Yes.
Assurance Financial. What makes like a lending institution like you guys different from like um, traditional banking institutions like Bank of America or Wells Fargo, etc.?
Okay. So Assurance Financial Group is a lender. That means that we rely on internal funds within our company to lend out to clients. If you call us and you need to talk to your lender, which is what I am, my loan officer assistant, so he helps me in my office gathering documents, communicating with clients if I'm not available. Then I've got a processor, an underwriter, the person who audits the loan. Basically, anything or anyone that touches the loan throughout the process is all in-house. They are an Assurance Financial employee. We have autonomy to make changes. So let's say we have someone who maybe their credit score is not quite high enough, but they've got a lot of assets and we can make an exception. We have that ability to do that. If you speak to a broker at a mortgage brokerage, they may not have the autonomy to be able to make those changes. They also are going to rely on people who don't work in house. They work at the 20 plus different companies that the broker shops the rates to. So it's not always as seamless of a process. And then you don't necessarily have a relationship with them ongoing. As a lender, we do tend to maintain the servicing rights for a big deal of our portfolio. So if you need something, it's still going to be an Assurance Financial person answering your question 3 years down the road. Then a difference between lenders, brokers, and banks. I actually got my background for over a decade working for one of the largest banks in the country. And in that role, I worked in a lot of different departments, so I got to see a lot. And my mentor was a mortgage lender. And he had told me many times, don't go into mortgage, don't go into mortgage. It's hard. There's a lot of hoops to jump through. I have to make clients really angry, before we get to the closing table. I miss my closing dates. And I'm not saying that all banks are like that. However, typically when you are dealing with a bank, there's just a ladder of people that are involved in the process, and they're not always going to see, that the light is at the end of the tunnel, that there's a solution. Let's find the yes, because we want to do business. When you talk to someone here at my company, we all have this sense of urgency that if we say that we're going to close by a certain date, even if it's 3 weeks from now, if you go under contract and we say we're going to close by that date, we will do everything that we can to close by that date. Banks, brokers, not necessarily the deal. You've also got, to dig kind of deep into it, people who work at a bank as a mortgage lender, they do get paid less per deal than a broker or a lender. So what you should think about that is you're not going to feel that out of you, the borrower's pocket. You're not going to feel that because it's built into the loan, the pricing of the loan. We may not have as much overhead because we've got a couple of branches that have recently opened, and they've opened in homes. So those branches are not paying rent and electricity and all this on a big commercial building the way that banks do. And then, the most exciting part of that is, because I have less clients that I need to help at a time to make the same amount of money, I'm focusing more on you as the borrower. I don't feel that I've got to rush through our conversation or not keep you up to date the way that some of my friends who are in that mortgage world and banking do. So you've got my full attention, and I mean it when I say that I will work, whether it is 8 or 9 a.m. all the way through the night. As long as I get my couple hours at night with my son. If you need me to work on your loan application at 8 o'clock at night, or if it's 10 o'clock and you've just now been able to open your appraisal report and have questions, I'm going to help you. You won't always get that with a banker.
Okay. So is it fair to say that, all the things that you said, that basically the accessibility and the homey feel, because you guys are, in-house everything, you kind of work from home, that, you're going to get a little bit more service from you guys than those traditional banking systems?
Yes.
Okay, great. Now, definitely, I could say from firsthand that, you are speaking some truth, because I sent you a contract, it was supposed to close in like a month, but I sent it to you like a week late. And right now we have no problem and we're on track. So
Yeah.
we can attest to that. Okay, let's go to this next question. I just want you to kind of briefly explain to people, because the difference between the different loan types, like a conventional loan, FHA, VA, and USDA. They hear all these loan types, and usually what they do when they call in to a lender, they give them their information, and they just say, "Hey, here's your pre-approval on this type of loan," and then they say, "Hey, well, why I didn't get this type of loan or that type of loan?" So can you kind of like briefly explain the differences between them?
Yeah. So, we live in a country where mortgage is heavily regulated, as it should be, based on some things that happened in the past. And as a result of, just kind of what the economy went through after the housing market crash in 2008, there are specific loan types that are backed by the government that are there to help people who may not afford a conventional loan. Conventional meaning 5% or more down, up to the amount of $647,200 for most parts of the country. And then in your urban, metropolitan areas like Washington, D.C., New York City, that number is a little bit closer to $1 million. So that's kind of the easiest mortgage loan to fit into if you meet certain income, debt to income ratio, and other guidelines. So these other programs, FHA, VA, and USDA, they're all government backed. And just kind of as a blanket rule, you typically need to have somewhere between a 600 to a 620 to qualify for these programs. If you don't, then you've got to have enough compensating factors, meaning cash money in the bank, or a gift that's being given to you that's cash money that you don't have to pay back to a family member. Or maybe you've got a large income, something like that is a compensating factor. So the easiest two to get into from an income perspective is USDA and VA. VA, Veterans Administration, is specific to people who currently or have served in the military in the past, or a surviving spouse of that person who served. You can get up to 100% down on those. You can put cash down, so just because you have 10% to put down and you're a veteran, you still want to look at the VA loan because of the cost savings involved, especially if you are considered any percentage disabled as a veteran, 5-10%, because you maybe can't hear as well in 1 year from ammunition. As long as you are getting a disability payment from the government each month, you get to waive your funding fee. So it does end up being a lot cheaper on the front end for you to get into that loan. A USDA loan, that is the United States Department of Agriculture, and those are considered rural development loans. A cool thing about South Carolina in particular is most of the state falls into that category. As long as you are not in Charleston, Greenville, or Columbia, and then other certain pockets like Hilton Head Island or Myrtle Beach, where there is a high density, most of the homes that you find are going to fall into that. So right here in Columbia, where I'm from, Dillon, South Carolina, both of my grandparents were farmers. All of Dillon is a USDA. But here in Columbia, you think, this is the big city, we can't find a USDA property here, but Columbia is surrounded by rural land. So, as my job as the lender is to look at the map and see, the area you're looking at, does it fall into that? And if it does, if your income is below a certain point, it is based on the number of people in your household and then what each of those people earn. So if you fall within that category, then you may qualify for the USDA 100% down. You also have a limitation of how much cash that you're allowed to have on hand for that. For instance, if you have a lower income, but you received a large inheritance, you still may not qualify for that. So I just determined that by taking your application and asking questions.
Okay.
The next one, which is really popular, is FHA, so Federal Housing Administration. That one is popular because it has a 3.5% down payment rule, which, you think 3.5% or 5% for conventional, that's not that big a difference. But when you're talking about $100 or $200 or $300,000 in the price of the home, that really does make a big difference. So we, with me being the real estate and mortgage expert, it's my job to ask you questions, take your application, figure out, hey, it looks like I see this answer on your application. Can you tell me more about that? So I kind of dig in and make sure I'm getting everything, even if you left it off of the application. And with that, I craft the solution to tell you what your options are, what you qualify for, and the advantages and disadvantages of each loan type.
Okay, that's great. Great information. And just going off of that, I'm just going to go right into the next question, which is credit and DTI, which is what?
Those are things that there are a lot of myths out there. So I have been in banking and finance and financial planning for a while, over the past 13 years. And I have seen everything from the family that I grew up in, which my parents went through bankruptcy and foreclosure when I was in high school. And it is a driving factor for why I do what I do, because my goal is to bust those myths and make sure that I'm educating people. If I get an application right now and the credit or something doesn't qualify for a mortgage, I don't just say good luck next time. I actually dig into that credit report. I point out things that they can take care of now, or if it's a late payment, how long they have to wait for that to be removed from the credit report. So when people talk to me and they walk away, they know they have a plan. They've got my support. I want to talk to them. So I follow up with folks on basically an every 3-month basis after I give them a plan. So to dig into kind of what's accepted. So myth number 1 is you have to have a 620 or higher to qualify for a mortgage.
Mm-hmm.
That's not necessarily true. All right. So not every credit score is created equal. There's a pie chart that with 5 different categories that it's based off of. And you might have a 620 because you have recently finished school and you don't have maybe any, or maybe just one form of credit. Maybe it's a student loan that you got freshman year, but you just finished school, so you haven't had to make a payment on it. So you're kind of starting from the bottom and crawling up. Credit scores go as low as a 350. I have never found one below a 400. And I very rarely run across one below a 500. So most of them are going to fall 500 and above, up to about an 820 is the max. You could have a 580, a 590, a 600. And if you've got that, down payment, or maybe you've got a down payment assistance program, something like that, you may still qualify for a mortgage program. Another myth is myth number 2, straight from my parents' experience. If you've had a bankruptcy, You don't always have to wait the full 7 years before you qualify to buy. It depends on the type of bankruptcy you had, whether the debts were paid off, and when the judgment was released, or if you got a letter from the attorney stating that you were in the clear now. As long as it's within about 2 years or more, we can sometimes get you in a mortgage. So you don't know till you ask. So don't let that be the deterring factor.
Definitely.
Next up is debt to income ratio. So that means the debt is what you owe, car payments, house, credit card, sometimes medical bills, electricity bills, things like that. Those don't actually show up on your credit report unless you haven't paid them, which unfortunately means that if that's the only credit that you have, you're not actually impacting your credit score. You're not building credit. So it is important that you, the easiest way to start is with a credit card. If you don't qualify for one up front, which is typically a 650 or higher credit score, you need to get a secured credit card where you pay cash to, it's put into an account. It's still your cash, and the credit limit is based on how much you put in that account. And it helps you until you do get up to a 650 or 675 credit score, and then qualify for that credit card. Once you've got that, then you probably qualify to buy a car. And then, later on, you'd qualify to get a mortgage. So with the debt to income ratio, we are going to look for a maximum of 45%, sometimes 50%. And what that means is if you've got $100,000 total combined income between you and the person applying for the mortgage, and you've got monthly payments that they just need to not exceed the 45%, including the home that you're going to purchase, the taxes, the insurance, the if there's a homeowners association fee, that impacts it. If you're putting less than 20% down on the mortgage, which is extremely common today, you'll have something called private mortgage insurance. So all of those things get factored in. We are not going to factor in your daycare bill, or your phone bill, anything that doesn't actually report to credit does not get factored in there. We just want to make sure that you've got enough money to live off of to handle all of those things outside of that 45 or 50%.
Okay.
Next question.
That makes perfect sense. You want to be, like I tell everyone, you want to be prepared, not even financially, but also mentally and physically as well. And everybody's protecting everyone when it comes to that. So that's a good thing. Not people just trying to, sell mortgages and get them out there any way they can. So great. The next question, which is question number 4, I just wanted you to briefly speak on like the underwriting process. Once I bring a client, we're under contract now. They've been pre-approved. We have our contract is ratified, and then hey, now we're starting to go into the loan process and underwriting.
Okay. So when we talk about rates, the trend over the past 2 years has been, oh my goodness, rates are so low. Refinance your mortgage, refinance your mortgage. That is absolutely what should have been happening. If you didn't refinance your mortgage or buy during that time, then unfortunately you've kind of missed out. So back around January, we were quoting rates still around 3.5%. Historically, that is still low. And, the market was really hot. Everybody was coming out of the woodworks wanting to buy. Well, now the rates have kind of started to shift up. And so what happens is typically when there's a Democrat in the presidency, rates tend to trickle up. That is because the rates are tied to treasury bonds, and the treasury is tied to the government. So as those treasury bonds go up, mortgage rates go up. When you talk about a rate for buying a car or a credit card, typically it's kind of set by that bank or that entity that you're borrowing from. It is not like that with mortgage rates. Rates fluctuate every single day. I've gotten a contract. I think a client I'm working on for you right now is a really good example where I got the contract, and by the time I entered in some key notes in the system, boom, we went to. By the way, I think I've just circumvented your underwriting talk. So I'll circle back to that in a
That's
moment.
fine.
I'll tie it in. So the rates can change so fast that in the 5 minutes it takes me to open an email, input the information I need to input to get this sent to underwriting, the rate could change just that fast. So we keep the treasury bond market up in the office all the time, so we know it makes this sad noise when rates are going to get higher, and it makes a clapping noise when rates are going to go down. So it helps me in terms of knowing, like, hey, I'm still going to submit everything I need for the contract, but am I going to lock the rate right now because I'm anticipating the rate to go up? Or do I wait until because I just heard a clap, give it 10 minutes to go back down? So the underwriting, that is where all of the people who are going to touch your loan, there's at least 5 to 10 people who are going to touch it from the time that we take the application to the time that you get to the closing table. And that's just here at Assurance Financial. That's not counting the attorney, the title company, the realtor, the seller's realtor, all those folks. So when I get your contract, you've ratified it, you've signed, it's considered a done deal pretty much. I lock in the rate. I have to do some disclosures that are required by law. So I click a few buttons in my system. And when I hit submit, it immediately goes to my processor. The processor works with my loan officer assistant here in my branch to make sure that they have everything they need, like income documents. Do we need the home insurance quote now, or can we wait a few days for that? Is there a homeowners association that we're going to have to pay? Are there repairs that are required in that contract? And if they are, we have to get proof that those repairs have been done before the closing occurs. So once the processor feels like they have everything that they need, and the client has, uploaded any documents that we need from them, at that point we submit it to underwriting. Underwriting goes back and just revisits what the work that I did when I pre-approved the borrower, and then when I entered the contract. So you essentially have 3 different sets or 3 different touches on the credit piece of it, and making sure that the loan is marketable and safe and makes sense for us and for the borrower. Then you typically are going to get your clear to close, meaning that everything that we possibly need to do on it, that clear to close can come a week before the closing. It can come the morning of the closing. And thankfully, the environment we live in, the attorney knows it could be that morning and it's fine, as long as we keep those lines of communication open.
Yes. Okay. Well, definitely that answered my question, and it also answered my 5th question, which it was going to be about the rates, which you did a great job explaining that. And those are pretty much all the questions I have for you. I did want you to kind of briefly go over any products or services you guys, Assurance Financial, may have that maybe, something somebody else doesn't offer, or stuff that people, don't know about. I'll just give you the floor to kind of do that.
Yeah, absolutely. So at Assurance Financial, we want to help as many people as we can. So it's a lot easier for me to tell you what we don't have than what we do have.
Okay.
So just, you as a realtor, people looking to buy, people looking to sell, when they think about who they want to call, you don't want to have to call 10 different people to find a product that fits you. When you call me, I have it. I've got the product you need. I'm going to figure out which one fits your situation the best. So with that said, I'm just going to name a couple of them. The programs I talked about earlier, we offer all of those, not just from purchase, but we also do the same thing for construction. So up to 100% financing for USDA and VA construction, which is very rare. So we are happy to do that for clients. Um, one thing that is not really talked about much is state housing and city housing down payment assistance.
Mhm.
So someone who doesn't necessarily have the money to walk into a contract, and maybe USDA doesn't make sense for them because their debt to income ratio is going to be too high to afford to buy a home that they consider to be livable. So those folks should talk to me first, but we will talk to the State Housing Authority or Columbia, City of Columbia, about these down payment assistance programs. We are recognized on the state website and the city website as a preferred lender because of the volume of business that we do. So you can rest assured that we know what we're doing with those down payment assistance programs. Specifically with city lender, we don't have a lot of folks in the city of Columbia who qualify to lend. There are 7 banks, and they are mostly big banks. And then there's us. We're the only non-bank lender who will do a City Lender 1 or City Lender 2 program. And so that gets you the down payment assistance that you need. And on each program, it's kind of based on, income, credit, those types of things. So then the next thing I have that I want to mention is a renovation loan. A big myth about mortgages is that you have to have 20% or greater equity in your home, or you have to have cash in order to afford to do a renovation. That's not true. My company, and I'm the only one that has offered this around Columbia, we will go up to 75% of the post-construction value. Typically, it's 80% of the pre-renovation value.
Wow.
So instead of us having to do, wait several years, it's huge. And you can buy the house, you don't have to already own the house. So for instance, I've got somebody, I reached out to a realtor who had a house on the market and it had been sitting there for a while. And I looked at the photos, and given the neighborhood that house is in, the person who buys it is going to renovate it completely. So they're a good example of, I can help finance the purchase, and your contractor bid, so we know what we're probably going to spend on that contract before you're closing. It's a one-time closing, so you're not paying double fees. And then you will jump into that process with us. We wire the funds to the builder. We do a virtual inspection post renovation phase. So it's very streamlined for the builder to get paid. He doesn't have to wait for a check in the mail. You don't have to wait for an in-person appraisal. So, and in fact, I've got a consultation with a client in just a minute. So I'm going to wrap up. The key thing about that reno loan is you can do a purchase or a refinance, and it can be on your primary property you live in, your secondary, your vacation home. And I can even do that on investment properties. So if somebody buys an investment property and it's just in a really bad condition, I can help them flip that so that they can get a long-term renter in there. And then last but not least is investment properties. We will base your underwriting on the cash flow of the property, meaning what you are charging in rent, not on your full financial picture with your car and your mortgage and all that stuff in it. So investment properties are a little easier to attain than you might think through that program.
Okay. Wow, that's great information. Thank you, Abby. I know you got to wrap up and you got some things you got to do today, but I really appreciate this conversation you've given me, and I'm sure you've given the people watching a lot of great info. And they'll be reaching out to you, and hopefully we can get some people some homes or some investment properties or whatever they need. So thank you so much.
I hope so. Thank you so much for your time, Earl. This was fun.
No problem. No problem. We'll do it again for sure.
All right. Thank you.
Bye.
Bye.